All right. Good morning, everybody. Welcome to our YouTube session, Trading Time for Money, selling out of the money options for profit. So I say good morning because I am here in Napa Valley, Northern California. My name is Steve Moses, and we are going to we're going to talk about selling options. We're going to talk about selling out of the money options for profit, or trading for profit. And if anybody has any questions, please put them in the chat box. If you want to put in the chat box where you're from, that would be cool. And if you have any questions, put them in the box. All right. So trading time for money. All right. Options are an amazing asset class, and we're going to talk about it for probably 45 minutes to an hour today. So that'll be great. But we're trading for one reason, which is to make a profit. And you can trade stocks, you can trade futures. Some people trade forex, currency traders. You can trade options. Some people trade bonds. Some people trade real estate, invest in real estate. And there are a lot of assets to trade for income or for wealth or for protection. I've been trading options for almost 18 years, and I think options are just amazing. And one of the reasons that options are amazing, and I think maybe the most amazing asset class, and we'll talk about it in a second, is because we can trade time for money. If you're trading stocks, you're trading stocks. You're buying to open, sell to open, buy to close, sell to close. You're buying and selling stocks, but you're actually buying and selling the stock. It has value. You're buying and selling futures. You're trading futures contracts. They have value. You're buying and selling forex lots, currency. There's an exchange rate. They have value. Okay? You're not trading time. You're trading value. Well, with options, you can trade value, but you can also trade time. We can trade options that are out of the money, and we'll talk about that. All right. So let's just get a few things straight here. Why are we in the stock market? Or why are we in the financial markets? Why are we looking to invest? To make a profit. That's it. That's the only reason. I'm going to assume everybody on this webinar today is a capitalist. You're looking to make money, and you're looking to make a profit. Just to be fair, by the way, some people trade for more than one reason. We have day traders, people who are trading for profit intraday, swing traders, maybe trading a couple of days, a week, maybe a month, position traders or long-term investors, maybe in a retirement account, more buy and hold type traders or investors. Okay, so you're either trading the income bucket or the wealth bucket. Okay, but we're trading to either make a profit or keep a profit. There are times where you can trade where you're not really a trader. You just have investments. You might have $1 million retirement account and you're not really trading it. You just want to protect what you have, but you're either trying to make money or keep your money and protect your money. Okay. So the reason we're in the markets is to make a profit. That's it. It's the only reason. Now, as I mentioned a second ago, I think options are the greatest thing ever invented. Okay. All right, maybe not as good as single malt scotch, but I think options are the greatest financial asset ever invented. You can obviously make millions of dollars trading anything. You could go broke trading anything. Okay, but why do I think options are the greatest financial asset ever invented? Okay, and again, we trade or invest in options or any other asset for only one reason: for profit. Okay, however, what if you could profit and not have to worry about being right directionally? I want you to think about this. I just made the comment that you can make, millions of dollars or lose millions of dollars trading stocks, futures, forex, or even options, real estate. You could invest in businesses, invest in cars, venture capital, whatever. But here's the thing. If you haven't traded options, you are what I call a directional trader, meaning you invest in something because you're expecting the price of that asset to move in a certain direction. If it moves in that direction, you make money. If it moves in the opposite direction, you lose money. Pretty simple concept. You buy a stock, it goes up, you make money, goes down, you lose money. You short a stock, goes down, you make money, goes up, you lose money. Okay, same thing with real estate. You buy a house, value goes up, you make money. They find toxic waste in the backyard, value of the house goes down, you lose money. You trade futures or forex contracts or lots. You buy them, they go up, you make money, go down, you lose money. If you sell them short, go down to make money, up, they lose money. So again, one more time. How you doing, Micah? I'm doing great. It's Friday. I'm in wine country. I'm talking about options, and I'll be having wine in about 6 hours. So if you get the direction right, you make money on your investments. If you get the direction wrong, you lose money. That's pretty straightforward for investing. And for most retail traders who are bullish investors, it's buy low, sell high. Okay. Of course, some people know you can sell high first and buy low second, but it's get the direction right. But what if you could profit and not have to worry about being right? And as a matter of fact, what if you could profit and even be somewhat wrong directionally? What if you could get into a bullish trade, the asset could actually go down and you could still make a profit? Or enter a bearish trade, the asset could somewhat go up and you could still make a profit. You could be wrong, just not really wrong. Okay, you can't be Enron wrong. You know, can't be going out of business wrong. If you're that wrong on the direction, you probably deserve to lose some money. Okay, but what if you could profit and not have to worry about being right? And what if you could profit even being a little wrong directionally? And the way we do that, what if we didn't just trade stocks? What if we traded time for money? See, most people trade stocks for money, trade futures for money, trade options for money, trade forex for money. Well, when you trade options, you can trade time for money. What if we sold assets that as time went by, those assets deflated in value and they expired worthless? We're going to sell time. We're not going to sell actual value. We're going to sell time. What if you could profit when nothing happens? What if you could profit and you don't need the underlying stock to move? You just need the calendar to move. So I just mentioned we're trading time. And here's the thing. If you trade stocks, futures, or forex, the asset has to move to make a profit. And it doesn't matter how long it takes. If you get stopped out in 1 day or 1 week or 1 month, or you hit your profit target in 1 day, 1 week, 1 month, doesn't matter. Matter of fact, how long can you stay in a trade? But you could stay in a stock trade forever. You could have bought Microsoft when it went public in 1986 and you still own it. Your great-great-grandparents could have bought shares of GE 115 years ago, and your family still owns the shares. But the stock has to move for a profit or a loss, and there's no guarantee the stock's going to move. But there's one guarantee in life. You know, guys, a lot of times I usually run through some disclaimers. You know, the one disclaimer that I always have is there's risk in the stock market. There's no such thing as a guaranteed trade. Any trade can go against you for any reason. I mean, think about it. If there was such a thing as a guaranteed trade, a trade that would deliver guaranteed profits, if such a trade existed, would I be here talking to you? Or would I be backing up the truck somewhere? So there is no guarantee that a stock or a futures contract will move. But here is the only guarantee I'll give you in the financial markets. The calendar is going to move. Does that make sense? So if we're trading stock, if we're trading futures, there's no guarantee that the price of that stock is going to move. And by the way, the price of a stock today could be the same price that stock was 2 weeks ago. Well, if the stock's in the same place as it was 2 weeks ago, no harm, no foul, no profit, no loss. But in 2 weeks, while the stock didn't move, what did move? The calendar. And if you're trading stock and the stock doesn't move, you don't make or lose any money. But if you're trading time, time is guaranteed to move. So if you get certain other things right, which I'll talk about in a second, you don't even need the asset to move. You just need the calendar to move. And the calendar is going to move. As a matter of fact, if the calendar doesn't move, we have bigger problems than our financial investments, okay? Because options have something that stocks don't have, an expiration date. So I mentioned a second ago, you could have bought shares of GE 120 years ago, and your family could have passed them down, passed them down, passed them down. You could have bought shares of IBM in the 40s. You could have bought shares of Microsoft 35 years ago. And you could own those shares. Matter of fact, you could pass away and your family, the shares could outlive you. Stocks don't expire. I'm not talking about a company going out of business or a company going private, and there are no more shares, but stocks by definition don't expire. But options have an expiration date. So when you trade options, you're not only trading in many cases directionally. When you trade options, you're not just having to be right directionally most of the time, but you have to be right before the option expires. You don't just have to be right on the where, you have to be right on the when. Well, that's when you buy options. So a lot of times options expiration hurts people because they buy bullish options, the stock doesn't move, and the option's about to expire. Okay? But when you sell options, the expiration date can be your friend. So let's talk about this now. Time is money. So look at this chart on Amazon.com. This was a couple of months ago. Okay. So Amazon.com on this day was approaching a supply area. The stock had been trading sideways for about a year. Now, when I say sideways, it was not flatlining. It was basing between 2,900 and 3,500. So a 600-point range, but it's a $3,500 stock. Okay. Now, Amazon is coming up here at supply. Call it resistance, call it supply, call it whatever you want. Here at Pinnacle, we call it supply. Down here, we have demand, not support. We have demand. Support might be down here. This is a demand zone. There are buy orders waiting for Amazon to get back to 2,900. But we're up here at supply, okay? Now, the day I took this screenshot, Amazon.com was trading at $3,502, $3,500 a share, okay? Now, if a stock is at supply or a stock is at resistance, what do you think the stock is going to do going forward? You think the stock is going to go up or you think the stock is going to go down? Well, if it's resistance or supply, we expect the stock to hit its head on supply and go down and roll over. Okay, just like it did back here a month or two earlier. What do we expect the stock to do at demand? Bounce, go up like it did 1, 2, 3, 4, 5 times. Okay, now eventually, just for fairness, eventually this stock is not going to be trading between 2,900 and 3,500 forever. Eventually it's going to break below 2,900 or blow past 3,500, but that's in the future. So we have a stock chart. We have a stock at supply. We're expecting a move to the downside. So we would look to enter a bearish trade on Amazon.com. Okay, now, if you shorted Amazon.com stock at $35.50, if it came up a little higher to supply here, and you shorted the stock at $35.50, what would have to happen for you to make a profit? The stock would have to drop. When you short stock, and it doesn't matter the price of the stock, you could short Apple at 140, you could short GE at 15, you could short Amazon at 3,500. But if you short stock, that is a directional trade, and you need the stock to drop to make a profit. Okay, now, shorting stock, as we all know, is the riskiest trade on the planet. Why? Because how do we define risk in the markets? I mean, if you buy a stock, your risk is in what direction? If we buy a stock, our risk is to the downside. How low can a stock go? Well, a stock can only go to zero. Can a stock go below zero? Nope. All right, give Goldman Sachs a couple of years. They may figure out a way for a stock price to go below zero. But today, a stock can't go below zero. But when you short stock, what direction is your risk in? When you short stock, your risk is to the upside. Well, how high can a stock go? To quote the great Ralph Cramden, to the moon, Alice. There is no zero to the upside. So shorting stock is the riskiest trade on the planet because you don't know how much risk you're really taking. I mean, look, don't get me wrong. If you bought Amazon at $3,000 a share and it went to zero, okay, it may be a defined risk, but you lost $3,000 a share. That hurts. But at least you know what your max loss, your max real dollar loss would be. But when you short stock, there is no zero to the upside. There is no max loss. Theoretically, Amazon could gap to 4,000 tomorrow. I know the probability of that happening is not great, but it could gap to 3,600. It could gap to 3,800. It could gap to 4,000. It could gap to 5,000. Okay? Whatever. So, if you shorted Amazon stock at 35.50, you would need the stock to fall to make a profit. In other words, you need the stock to move in the right expected direction. If Amazon drops, you make a profit. If the stock rises, you lose money. That's it. That's the directional trading we're used to. You get the direction right, you win. You get the direction wrong, you lose. Pretty simple concept, right? Now, what makes this so important is you got to get these market turning points right. If you're going to short a stock, you need the stock to drop. So you want to short a stock where you think it's going to stop going up. If you're going to buy a stock, you need the stock to go up. So you want to buy a stock where you think it's going to stop dropping and go up. Okay, we're not going to talk about supply and demand today. And we're not going to talk about market turning points today. Matter of fact, the visual you saw at the beginning of the webinar, we have some Pinnacle workshops coming up where we will introduce you to the concept of supply and demand and market turning points. Okay, but for now, if you're going to short Amazon stock, you need it to go down. That's a directional trade. If you short stock, it moves a penny in either direction, you're making or losing money. You short the stock, it drops a penny, you're profitable. Goes up a penny, you're starting to lose money. Make sense? Okay. Now, instead of shorting the stock and needing it to drop to make a profit, what if all we needed to happen to realize a profit was not for Amazon to have to drop, but for Amazon to just not go up? Would that make sense? Would that be cool? Now, some of you may have experience with options and you may understand this. If you've never traded options, then this is going to blow your mind. So watch. The distal line of this supply area is 35.54. Well, when I took this screenshot, the stock was at 35.05. Are you with me? Now look up here. I drew a line at 35.80. I will explain why 35.80 in just a moment. But let me ask you just a question. What if we could enter a trade on Amazon.com and all we needed the stock to do to make a profit was stay under 35.80 for maybe a week or two? That's it. As long as Amazon doesn't go above 35.80, you could make a profit. Does that make sense? Now, by the way, if the supply area or the resistance area, if we don't think Amazon is going to go above, based on supply, Do we think Amazon is going to go above 35.54? Nope. Well, let me ask you a silly question. If Amazon doesn't go above 35.54, can it get to 35.80? No. Now, I didn't say can it get to 35.80. Of course it can. This stock could easily gap up 75 points the next day and get to 35.80. But my question was, if Amazon doesn't break the supply area, if Amazon doesn't go above 35.54, can it get to 35.80? No. So what if we rendered direction irrelevant? What if in order to make a profit on a bearish trade, we don't need Amazon to drop, we just need it to not go up. We just need it to stay under 35.80. We just need it to stay under a level it's already under. What if we rendered direction irrelevant? Guys, what has to happen for a stock trading at 35.05 to stay under 35.80? What has to happen? Nothing. It's already under 35.80. So remember I said we're going to trade time? What if we entered a trade that expires, say, next Friday, and all we need to profit is the stock to stay under 35.80, a level it's already under? So what does this stock have to do in the next week to be under 35.80? Nothing. It's already under 35.80. This is the definition of what I call a non-directional trade, which if you've never traded options, you've never heard of. Because if you short the stock at 35.05 or 35.50, it has to go down. If you buy put options, it has to go down. But I'm going to show you a trade where it doesn't have to go down. It just has to not go up. And it could even go up and still make a profit. Now, let's take a look. In this example, Amazon was trading at 3,500. Okay? What if we enter a bearish trade with the stock at 3,500? And again, all we need to profit is the stock stays under 35.80. That means if Amazon goes down from 3,500, is it below 35.80? Yes. If Amazon goes sideways at 3,500, is it below 35.80? Yes. If Amazon were to even go up 79 points, would it still be under 35.80? Yes. So let me see if I understand this. We can enter a trade. The stock can go in all three directions. Because, by the way, that's all stocks and markets and futures and forex does or do. There's only three directions: up, down, and sideways. And if you've never traded options, you have never been in a trade where the asset can go in all three directions and you can still make a profit. If Amazon goes down from here, like we're expecting, we'll make a profit. If Amazon goes sideways from here, we'll make a profit. If Amazon goes up 50 points, let alone 79 points, we will still make a profit. Now, obviously, if Amazon goes up more than 80 points, we're going to potentially start taking a loss. But still, we could enter a bearish trade. The stock could go up 80 points. Over the stock, we could enter a bearish trade. The stock could go up over 2%, and we will still make a profit. Wow. Now, let's talk about that. 35.80 is the price point we need the stock to stay below. It's above the supply zone. It's beyond the distal line of the supply area, which means we are not expecting Amazon to go above 35.54, let alone get to 35.80. So I asked the question a moment ago, if the stock doesn't go above 35.54, can it get to 35.80? And the answer is, of course not. It cannot do that. Okay, now, how do we profit where a stock doesn't go? Well, what we're going to do is we are going to trade out of the money options. Okay? Out of the money options have no intrinsic value. Now, if you're new to options, I'm just going to take a couple of seconds here to explain intrinsic value. Okay, so now, we really didn't start the day talking about what options are, but options are like coupons. They give you the right to do something in the future. So a call option. If you wanted to buy Amazon at $3,500 a share, okay, you could buy 100 shares of Amazon at $3,500 a share. It would cost you $350,000, but you could do it. How many, if any of you, well, in this trade, Juan Delay, yes, it is. And I'm going to explain that in just a second. Yeah, hang on. Okay. Great question. So guys, for those of you who trade futures, if I have any futures traders on the webinar, if you're trading an oil futures contract, you're not actually trading oil. You're trading an oil futures contract, which gives you the right to buy oil. So if you go long an oil futures contract, so oil this morning was at around 73 bucks a barrel. Now, if you buy 1,000 barrels of oil, it costs you $73,000. But if you go long an oil futures contract at 73, you don't have to put up $73,000 because you're not buying the oil. What are you buying? An oil futures contract, which gives you the right to buy 1,000 barrels of oil. When? In the future. It is a leveraged asset. You may only need to put up $3,500, $4,000, $5,000 of margin to go long that oil futures contract. Does that make sense? Okay. Options are like futures contracts in that sense. It's a leveraged asset. So if Amazon is at $3,500 a share, okay, now I know we're not expecting it to go up, but if you thought Amazon was going to go up, you could buy 100 shares of Amazon at $3,500 a share, and it would cost you $350,000 to buy 100 shares. Well, just like you didn't have to spend the $73,000 for the oil, what if we bought a call option at $3,500? So as you see my cursor right here, a $3,500 call option would cost you 24 bucks. Now this option expires in 2 days. Don't worry about that, but that's okay. But it would cost you $2,400 to buy the right to buy Amazon at $3,500. $350,000 to buy 100 shares of stock, $2,400 to buy a call option giving you the right to buy 100 shares of stock. Does that make sense? Now, options have a premium. You're going to buy or sell, just like the stock price is the stock price, and you either buy a stock or short a stock. If Amazon was trading at $3,500, you're either going to buy 100 shares at $3,500, or you're going to short shares at $3,500. Okay. Options have premiums too. And if you're going to buy this option, you're going to pay the ask price. If you're going to sell the option, you're going to collect the bid price. The bid and ask is the same as the bid and ask on stocks. Okay. Now, I mentioned that we're going to go here and we want to profit by Amazon staying under $35.80. So here's what we're going to do. Look at the $35.80 strike price and the $35.90 strike price. Now, what is intrinsic and extrinsic? That is the value that options have. Okay? An option premium consists of two things: intrinsic value, what it actually has to be worth, and then extrinsic value or time value. See, what makes options unique, options are the only asset class where you will buy or sell the option for more than it's literally worth. So if you want to trade Amazon.com right here, when I took this screenshot, the stock price is $3,500.48. That's it. You want to buy the stock? $35.48. There you go. You want to short the stock? $3,500.48. That's it. If the stock is trading at $3,500.48, you're not going to pay $3,600 for the stock. The stock price is the stock price because it's the stock price. The futures price is the futures price because it's the futures price. In forex, the exchange rate is the exchange rate because that's the exchange rate. And the P&L only happens if any of those things change, if they move, if the price of the asset moves. Now, a stock at 3,500 has $3,500 of intrinsic value. But look at these option premiums. Now, every number, by the way, you see where it says strike price here? Those are the different coupons, or those are the different contracts that you can buy the right to buy or sell Amazon stock at. Well, once you go above 3,500, these options have no intrinsic value. They're worthless intrinsically. Well, why is there still a premium? Why is it going to cost you money to buy them? Because we're paying for this. We're paying for time. Okay? And that's where options are different than futures contracts. Futures, you just have to be out of your trade by an expiration date. Options, you have to be out of your trade by an expiration date. But you're going to pay for the time between now and the expiration date. So guys, look over here at 3,500. Okay? It says there's $3.82 of intrinsic value. That means when I took this screenshot, Amazon was trading at $35.0382. If you paid $3.82 a share for the right to buy Amazon at 3,500, okay, you would pay $35.0382, and that was the stock price at that moment. But wait a second. Amazon's only trading at 3,500. If you want to buy a coupon, buy an option to give you the right to buy the stock at $35.80, well, first of all, who's going to buy an option? Who's going to buy a coupon giving you the right to buy a stock at $35.80 if you could buy the stock right now at $35.03? Nobody. So then why is there premium here? Because that's extrinsic or time value. When you trade options, you're not just trading what it's worth intrinsically. You're not buying and selling an intrinsic asset. You are also buying and selling time. You are trading time. I love you, Brian. There you go, buddy. That's who's going to be on the that's who's going to buy a $3,500 stock for $35.80. You either know me well or you or you're from New York. Either way, I love it. But you are correct, sir. All right? So guys, when you trade options, you're trading time as well as the asset. And remember what I talked about 20 minutes ago. If you're trading stock, you need the asset to move. But if we're trading time, we don't need the asset to move. We just need the time to move. And that's the guarantee. Time is going to move. You can't stop time. I mean, frankly, if you could stop time, you wouldn't need to trade options. Okay? But I can guarantee you the calendar is going to move. And when we trade time, as time moves on and there's less time value. So just watch. $35.80 is the price that I think Amazon is going to stay under. And again, why do I think it's going to stay under $35.80? Because I don't think Amazon is going above $35.54. That's it. And by the way, this is not my opinion. You know, what we teach here at Pinnacle is not trading your gut. It's not trading your opinion. Why do I think? I don't own Amazon stock. I'm a Prime member. I don't pay for shipping. I get stuff shipped to my house. I don't own Amazon stock. I have never owned Amazon stock. I am not in an Amazon trade today. I've got no vested interest in Jeff Bezos or Amazon. But on this day, why did I think Amazon was not going to get to $35.80? Because I don't think it's going past $35.54. Because I think that's where the institutional sell orders are sitting. That's it. Okay, that's not my opinion. That's what I think is going to happen. So What if I sold? So if somebody wanted to buy a 35.80 call option, okay, they're buying the right to sell the stock at they're buying the right to buy the stock at 35.80. Okay. Whether they're Red Sox fans or not, they're buying the right to buy the stock at 35.80. When you sell a call option, you are obligated to sell the stock at that strike price. So if somebody is buying the right to buy Amazon at 35.80 and I sell them that option, then I'm obligated to sell them Amazon at 35.80. But here's the thing. I will probably never have to fulfill that obligation to sell them Amazon at 35.80, because unless Amazon goes to 35.80, who's going to buy a stock that's trading at 3,500 for 35.80? Who's going to buy a stock that's trading at 35.79 for 35.80? I don't even think a Red Sox fan would do that. Okay. So if the stock doesn't get to 35.80, I will sell them an option. I'll collect a premium, and I will never have to fulfill the obligation if the stock doesn't get there. So let's look at this. 35.80 right here. Someone's going to buy that option for $4.20. It's worth nothing intrinsically, but they think it's going up. Okay. Hey, you had your year 5 years ago, Hefe. Okay. You had your year 2015. You won your one World Series. Leave me alone. All right. I remember Yankees beating the Royals in 76, 77, 78 every year. Let's not go there. Okay. So guys, right here. Okay. Someone's going to buy a 35.80 call option, and they're going to pay $4.20. Now, by the way, you know what the bid-ask spread is. Okay. There's a 50-cent spread. You can obviously put a limit order in and try and split the difference, but okay. If I sell them this option, okay, let's just split the difference. Let's say $4. They end up buying it for $4 and selling it, and I sell it for $4. That means I just collected $4. Okay, I sold something that's worthless. Guys, if a stock is at zero, you cannot sell it. But if an option has zero intrinsic value, I can sell it. Because I'm not selling intrinsic value, I'm selling time value. Okay, now, I don't know that Amazon is going to be above or below 35.80 in 2 days. But what I know is 2 days is going to get here. Okay, now, I'm going to sell an option down here at 35.80. And I'm going to look to buy an option at 35.90. And what I'm going to do is this, okay? We placed a trade. I was in the exchange in some of the webinars I do at Pinnacle. This is a real live trade, or it was back, in June. We're going to trade two options at the same time to create a credit spread. We're going to trade time. We're going to sell a 35.80 call, and we're going to buy a 35.90 call. We're going to buy and sell options that have no real value, no intrinsic value. We're selling 962 of time, and we're buying 832 of time. So by the way, guys, if we sell something for 962, but then we buy insurance or buy something for 832, we're left with $1.30 credit. Now, $1.30 doesn't sound like a lot of money, but options are sold in contracts. Each contract gives you the right to trade or buy or sell 100 shares of stock. So for every contract, for every credit spread we sold, we would collect $130 for one contract. If we did 10 contracts, we would have collected $1,300. Okay? So we're going to trade options that have no real value. No intrinsic value, but what they have is time value. So we won't need the stock to move, only the calendar to move. So again, as I just mentioned, when trading stocks, The stock has value. The stock price is the stock price because it's the stock price. Now, whether you think that stock price is overvalued is irrelevant. Whether you think Amazon is worth $3,500 a share is, who cares? I don't care what you think. And by the way, don't take that personally. I don't even care what I think. Your and my opinion means nothing. If the stock is trading at $3,500 a share, then the last person who bought it, the last person who sold it, thought it was worth $3,500 a share. That's the current price because that's the current price. Stocks don't have time value. Stocks don't have an expiration date. They only have intrinsic value. Whatever the price the stock is currently trading at is the price you can buy and sell it at. Now, I want to come back to here. Okay, so look at this. Remember, we're going to buy a 3580. We're going to sell a 3580 call option, and we're going to buy a 3590 call option. Remember, I said a minute ago that when we enter a bearish trade, our risk is in what direction? To the upside. Okay, so if all we did, so remember I talked about a minute ago. If you sell a stock short and the stock goes up, you're wrong. How wrong can you be? Unlimited wrong. There is no max loss when you sell a stock short. So guys, in life, if you have risk for something, what do you buy to cover your risk? Insurance. So normally, if you have a house, you buy homeowners insurance, protects you if the value drops. You have a car, you get car insurance, protects you if the value of the car drops. You buy life insurance, it protects you if your value of your life, if your life drops. You know, you can insure a boat, you can insure a wine collection, you can insure a baseball card collection. You can insure against financial loss. Now, if I sell a 3580 call option, I am obligated to sell this stock at 3580 no matter how high it goes. What if this stock goes to 4,000? I am now obligated to sell it at 3580. So I got to go out and buy the stock at 4,000 and sell it at 3580. Well, that sucks. Okay. So I'm going to buy insurance. I'm going to buy a call option now. I'm now buying the right to buy Amazon at 3590. Now, no matter how high this stock goes, if it does go above 3580, if it does go above 3590, if it does go above 3600, and I have to fulfill my obligation to sell the stock at 3580, I don't have to buy it at 4,000. I have the right, I bought insurance. I bought the right to buy the stock at 3590. Okay. If I have to buy a stock at 3590 and sell it at 3580, how much do I lose? $10. But if they gave me $1.30 and I have to give them back $10, what do I lose? $8.70 or $870 per contract. So if you shorted naked calls or you shorted Amazon stock, your margin requirements are out the wazoo. Most of us, you and I, will never trade Amazon. We cannot afford it. One share of Amazon was $3,500. 10 shares, $35,000. Okay? Call options for thousands and thousands of dollars. And if you ever wanted to short the stock, the margin requirements on shorting a $3,500 stock, out the wazoo. Okay, that's enough from the Royals fans. You got your one World Series, leave me alone. Okay, guys, if anybody took this trade with me, selling a 3580 call and buying a 3590 call and collecting $1.30 or $130, your max risk on this trade, if the stock went to 5,000, by the way, if you shorted the stock at 3580 and the stock went to 5,000, you lost $1,500 a share. Holy moly. Now, by buying insurance and turning this into a credit spread, we're going to make $1.30 if it stays under 3580. And if we're wrong, if we're really wrong, the most we can lose is $8.70 or $870 per contract. This stock could go to 10,000. We still have the right to buy it at $35.90, even though we're obligated to sell it at $35.80. The most we can lose is $10. They gave us $1.30. By the way, that means you could do this trade theoretically in a $3,000, $4,000, $5,000 account. So when you learn how to sell options, and if you learn credit spreads, you can look to profit off of stocks you can't even think about buying. I can't afford to spell Amazon.com, let alone trade it directionally. You want to buy 100 shares of Amazon for $350,000, you better have a $3 or $4 million account for prudent risk management, money management rules. You want to buy a call option for $5,000, you better have a $50,000, $60,000 account. Most people don't have that. And you're taking gap risk loss to the upside. This trade, max loss, $870 per contract. And we don't need the stock to move. The stock can even go up. We just need the calendar to move. So remember, stocks don't have an expiration date, but options do. So here's an option chain, okay? So again, there are multiple expiration dates on the left. There are all the different expiration dates that you see. On the right are all multiple, and there are a lot more strike prices than I'm showing on this screenshot. But, you know, the stock has a bid and ask, okay? And the bid and ask was $1. The bid and ask on the stock was $1. Bid and ask on the option prices is about 70, 80 cents. And you have to, so in order to do this, you have to know which expiration date to choose and which strike prices to choose. And that's predicated on understanding market turning points. We use the Pinnacle method to use supply and demand and find those market turning points. Okay, now in this case, this example, the trade expired in one day. You could have gone out 1 more week, 2 more weeks, 3 more weeks, etc. Okay, now you can close the trade anytime you want before expiration for a profit, or of course for a loss if the trade goes against us. Any trade can go against us, or we can let the options expire worthless, keeping the whole credit. So we got into this trade on June 22nd. This was a live trade at, this is Pacific time, 7:23 in the morning. So I sold, in one of my accounts, I sold 1 contract, collected $1.30 on June 22nd. The next day, basically 24 hours later, I bought to close this spread for 65 cents, which means we made I had to give back. So I sold the spread for $1.30, collected $130. I bought it back for 65 cents, or I bought it back for $65. So we got to keep $65 per contract. Now that, again, that doesn't sound like a lot of money, $65. But by the way, if you had a $5,000 account, you just got a 1%, 1.5% rate of return in a day. And you could have waited 1 more day and ended up keeping the whole $1.30. I mean, we didn't know that at the time, but keeping the whole $1.30. Okay? But I chose to buy this back because I got 50% of the credit, 50% of the profit in 24 hours. And the stock didn't have to move, and the stock could have even gone in the opposite direction. How cool is that? Now, guys, every trade has risk, and selling premium certainly has risk, because when you sell premium, you are taking on an obligation. However, when we enter non-directional credit spreads, the risk is limited. Even on this $3,500 stock, the call credit spread we entered limited our risk to $8.70 a share. That's $870 per contract. Will Amazon close above $35.80 when the options expire? Who knows? Again, if I knew that, if I knew where Amazon was going to be at the close of market on expiration day, I not only wouldn't be here talking to you, I'd be backing up the truck somewhere. You know that sound you hear? Beep, beep, beep. That's me backing up the truck. I would take a home equity line if I knew where the stock was going to be on expiration day. Okay? But my question is, isn't it cool to be able to profit with Amazon not needing to do anything? And it could have even gone in the wrong direction over 2%, over 79 points. And this trade was less than a week. So remember, we can literally sell options that are intrinsically worth nothing. You can't sell any other asset that's worth nothing. You can't sell a stock that's worthless, obviously. Not that you want to, but you can't sell a stock that's worthless. You can't sell a futures contract that's worthless. Okay? And by the way, if a futures contract went to zero, Lord knows what's going on in the world. Does that make sense, everybody? Because options, what make options unique is this column right here. Options are the only asset class. Look, expiration date. Yes, futures have an expiration date, but most people who trade futures day trade them, short-term trading them. You never deal with expiration. Options are the only asset class that, for all intents and purposes, the expiration date means something to us, but it is the only asset class where you have extrinsic value. You have time value. So if we're buying options, so look at this. This option right here, this 315 call option on Facebook. Okay, we're looking at a different chart here. This is a 315 strike price on Facebook. Okay, has 60. The stock is at 331.28. So 315 plus 16.28 is 331.28. But if we're buying the option, we're paying 19.05. Why are we paying 262 more than it's worth? Because we're paying for 22 days of time. And if we're selling this option, why are we selling it for more than 16.28? Because why are we selling it for 18.75? Because we're selling, in addition to what it's worth intrinsically, we're selling time. We're buying and selling time. Today is September 24th. There is 5 more hours until the market closes. So if you were trading options that expire today, you're not trading 22 days of time, you're trading 5 hours of time. Matter of fact, you can sell options that expire in 10 minutes at the end of today. Now, depending on the asset, they may not have a lot of premium. If you're selling GE options that expire in 10 minutes, there'll be a penny. But if you're selling Amazon options, how much could a stock like Amazon move in 10 minutes? Could move 20 points in 10 minutes. How many times do you see the markets sell off in the last half an hour of the day or take off in the last half an hour of the day? How many days do you see the Dow Jones tank 200 points in the last half an hour? Or the SPX, the S&P rallies 20 points in the last half an hour. Now, it could be news, or it could just be before a weekend, or it could just be whatever. Well, stocks can do that too. So if you're following the Pinnacle method, you're following supply and demand. And if you can identify market turning points, see, most traders look for those market turning points to find out where a stock will go. But if you want to trade time for money, you can use those market turning points to look at where a stock won't go. So look back here for just a second. I showed you this earlier. Look at how many times Amazon came down here to 2,900. Boom. And there were a few more times. Boom, boom, boom. Now, if you're a directional trader, if you're buying the stock, look, we want to buy low and sell high. Well, it's not just enough to buy low and sell high. If you want to buy a stock, what do you want the stock to do when you buy it? Go up. Well, in order to buy low, what direction does the stock have to be going in? That would be down. Well, do stocks tend to go down on good news or bad news? Bad news. How many retail traders are prepared to buy a stock that's tanking on bad news? Not many. Okay, if you could, you would. But what if you want to buy low and sell high and the stock is going down? What if you could buy a stock right where you think it's going to stop going down? And what if you bought it right where you think it's going to stop going down? No guarantee the trade's going to work out, but I'd rather buy Amazon here and get stopped out here than buy Amazon up here and get stopped out down here. So directional traders use supply and demand zones. Directional traders use market turning points to buy low and sell high, or sell high and buy low. Time traders, option sellers use the same market turning points not to see where a stock's going to go, but to trade where it's not going to go. So guys, we got into, if we're entering bearish trades up here and profit where Amazon's not going to go 35.80, what if down here we could enter a trade and all we needed Amazon to do was stay over 28.50, which, by the way, if it doesn't break the demand zone, it can't get to 28.50. How cool is that? So we teach here at Pinnacle, is what we do. We teach market turning points, the probability, no guarantee, but the probability of market turning points, the probability of finding where an uptrending asset will stop going up and where a downtrending asset will stop going down. Directional traders, God bless you. If you buy here, you could have sold up here. You sell up here, you buy it back down here, but you better be right. And if you're wrong, you lose money. And if you're right, you make money. But I just showed you the concept of buying and selling time. See, if you're buying puts up here or shorting the stock, it better go up. I mean, it better go down. Sorry. Better go down to make a profit. Well, sometimes it's not going to go down, but you can profit with it just not going up. Down here, you don't need it to go up. You just need it to not go down. So at the end of the day, we can sell intrinsic value of 0, because what we're actually selling is time. You never knew you could sell time. I mean, I'm approaching my mid-60s. Time is important. Obviously, time is time. By the way, time's a big deal. Some sports, there's a clock. Baseball doesn't have a clock. Baseball games never have to end. You could be down 10 runs in the bottom of the ninth. No out, 2 outs, nobody on base. Probability doesn't look good, but that game's not over. You could score 10 runs before you get the third out. But if you're down 21 points in a football game and there's 30 seconds on the clock, game over. Game over. You're down 10 points in a basketball game with 2 seconds on the clock, game over. You're just not going to get the ball back that much. So in certain sports, you can use the clock to your advantage or your disadvantage. Well, that's what we're going to do with options. The expiration date is the clock. And when we sell options, we want time to move as fast as possible. I mean, obviously, it's not going to move faster than time, but we can sell premium and profit when nothing happens, because all options will expire and most expire worthless. Guys, if something expires worthless, is that a good thing or a bad thing? The answer is yes. Well, the answer is it depends. If you buy an option and it expires worthless, that stinks. If you sell an option and it expires worthless, that's a beautiful thing. It's just like stock. If you buy a stock and it goes worthless, not expires, stocks don't have an expiration date. If you buy a stock and it goes to 0, that stinks. If you short a stock, that's what you want. You want it to go to 0 as fast as possible. Okay? Well, all options, unlike stock, all options have an expiration date, and most options will expire worthless. Okay? So we've talked about out-of-the-money options. We're at our 1 hour time here. And I don't want to go past an hour. Guys, I hope this was educational for many of you. We have some Pinnacle Method workshops coming up. If anything you saw today floats your boat, come to one of our no-cost introductory or advanced workshops. We have one tomorrow morning. I talked about throughout this webinar market turning points. I talked about in this webinar institutional orders. Where are the institutions looking to buy if they're bullish, short if they're bearish, whether it's stocks, futures, forex, or options. Okay. If you're some of you are brand new, maybe you've never traded or managed your own money before on your own, come to one of our introductory workshops for 90 minutes. Some of you may have traded before. Some of you may know who Sam is, Sam Seiden, but come to one of our advanced workshops. And again, they're all 90 minutes, no cost, just free. Spend 90 minutes with us and we'll talk about market turning points and think about options as an asset class. If you can learn the probability of market turning points, you can trade directionally if you want, but you can also learn how to sell time and trade non-directionally with the same market turning points. So we've got some really nice webinars coming up over the next week or so, and please join us. So Shar put in the link if you'd like to register for any of the workshops. Please join us. Otherwise, I hope you got a little something out of today. I really do think options are the greatest thing ever invented. Except single malt scotch, but you shouldn't drink and trade. That never works out good. But all trading has risk. But join us in one of the webinars. Thanks for joining me today. And I hope to see you in one of our webinars or one of our classes soon. And with everything going on in the world today with COVID and all the craziness, please be safe. Please stay healthy. Please take care of yourself and your families. And good luck with your trading and your investing. All right, gang. Talk to you all soon. Bye-bye.